Every year, millions abandon their homelands. People usually leave poor countries for a better life, and everyone understands why. Weak economies, political instability, limited opportunity. The reasons are obvious, and the pattern is as old as human history. But what is happening right now is something different, something that does not fit the standard story of migration, and something that the governments experiencing it are struggling to explain or reverse. The people leaving are not fleeing poverty or danger. They are leaving some of the wealthiest, most stable, most well-resourced nations on Earth. They are leaving voluntarily, strategically, and in numbers described as unprecedented in the modern era. 165,000 high-net-worth individuals are relocating internationally this year alone. Here is what is happening. The United Kingdom is not just losing wealthy residents. It is leading the world in losing them. No country is experiencing a more severe exodus of high-net-worth individuals in 2026, and the reason traces directly to a single policy decision that changed the mathematics of living in Britain for thousands of the country's wealthiest residents. For decades, the UK operated what was called the non-domicile tax regime, a system that allowed wealthy foreign nationals living in Britain to pay UK tax only on the money they earned inside the UK, rather than on their global income and assets. It was a competitive advantage. It attracted billionaires, international business owners, and global investors who wanted to base themselves in one of the world's great cities, while keeping their global wealth outside the British tax net. Thousands of them built their lives in London, contributing enormously to the economy, without bringing their full wealth picture inside UK jurisdiction. From April 2026, that system was abolished. The new rules require wealthy foreign residents to declare and pay UK tax on their worldwide income and assets. So many of them decided it was easier to leave. Dubai received them with open arms, zero income tax, and a golden visa program designed specifically for exactly this moment. But this regime abolition was not the only factor. Britain's inheritance tax system, already among the highest in the developed world, was extended to cover a broader range of assets. Capital gains tax rates were raised. The National Health Service, once the pride of British public life, now runs waiting lists of over 7 million people for non-emergency treatment. The private schools that wealthy families relied on to educate their children had VAT applied to their fees for the first time. Layer by layer, the advantages of staying in Britain were being removed while the costs were rising. And so people began to leave. The same thing is happening elsewhere. The United States has always been the dream destination for many. It has absorbed the ambitions and the capital of the entire world for a century. The idea that wealthy Americans would leave, not for another American state, but for another country entirely, was considered, until recently, impossible. California's top income tax rate sits at 13.3%, the highest state income tax rate in the country. New York's is nearly 12%. For someone earning significant capital gains or business income, the combined federal and state tax burden can reach 50% or more. Florida and Texas have absorbed waves of this domestic migration for years. But what is different now is that rich Americans are making a further calculation, leaving not just the high-tax state but the country itself. The second layer is political. The United States right now is a country so polarized that a significant number of its wealthiest and most mobile citizens describe the political environment as a primary driver of their decision to consider leaving. The bitter division between political tribes, the unpredictability of federal policy, the social tension that has made certain cities feel genuinely unsafe for their residents. These are not economic arguments, but they are real ones. Portugal, Spain, Greece, and the Caribbean have all reported sharp increases in American residency applications from people who describe themselves not as economically motivated but as exhausted. The Henley Report places the United States among the countries experiencing the most significant outflow of high-net-worth residents in 2026. For a nation built on attracting the world's ambitious, the reversal carries a significance that goes beyond the numbers. Moving on to the next country. Canada has a specific and particularly painful version of this story, because the people leaving are not just the wealthy. They are the young, educated, skilled, ambitious Canadians in their 20s and 30s, the demographic that every country depends on to build its next generation of taxpayers and innovators, are leaving in numbers that the country has not seen in modern history. The housing crisis is the most visible pressure point. Toronto and Vancouver have ranked among the least affordable cities in the world relative to local incomes for over a decade. A detached house in Toronto's suburbs costs over $1 million in a market where the median household income is under $100,000. Young Canadians who followed the prescribed path, which is good degrees, professional careers, responsible saving, discovered that the basic milestone of homeownership, which their parents achieved in their late 20s, had become genuinely out of reach in the cities where the best jobs existed. The calculation that faced them was stark: stay in Canada and rent for life, or leave and own. The tax environment added pressure. A significant increase in the capital gains inclusion rate was introduced in 2024, raising the proportion of investment gains subject to tax. Business owners and investors who had structured their wealth around the previous rules faced an unexpected increase in their effective tax burden. A country that built its modern identity on welcoming the world's most ambitious people is now watching its own people leave first. Now, let's take a look at this next country. Germany's departure story is different in character from the UK's or Canada's. It is not primarily a story of individual millionaires relocating to Dubai. It is a story of business capital, corporate headquarters, holding structures, and high-earning executives beginning to drift towards Switzerland, Luxembourg, and the Netherlands as Germany's economic and regulatory environment becomes less competitive. The German economy has faced years of genuine structural difficulty. Energy costs surged dramatically after Russia's invasion of Ukraine removed the cheap gas supply. The automotive sector, the backbone of German manufacturing and one of the largest employers in the country, has been undercut by Chinese electric vehicle manufacturers who are producing comparable cars at significantly lower prices. Economic growth has severely stagnated. As Germany debates higher taxes on wealth and capital, more wealthy individuals are shifting their money to countries where tax rules are more stable and predictable. What makes Germany's situation particularly consequential is the scale of what is at risk. Germany is not a small economy with a modest tax base. It is the fourth largest economy in the world and the financial anchor of the European Union. When Germany's wealthy and its business capital begin seeking exits, the ripple effects extend well beyond its borders. Next up is France. France has been through this before. The wealth exodus that followed the introduction of a 75% top income tax rate under President Hollande in the early 2010s was so dramatic and so economically damaging that the policy was reversed within 2 years. French capital fled to Belgium, Switzerland, and the UK in volumes that shocked the government that had introduced the measure. France appeared to have learned the lesson. But now it is again planning higher taxes on the country's richest people. As government spending keeps rising, taxing the wealthy has become a popular solution. Wealthy French residents, entrepreneurs, executives, investors, and inheritors of significant family wealth have begun accelerating plans that many had been deferring. They are moving legal and financial residency to Monaco, Switzerland, or Luxembourg, while maintaining their lives in France on a schedule that keeps them below the threshold that triggers full French tax residency. France's top earners pay a disproportionate share of its income tax receipts. The loss of even a relatively small number of its wealthiest taxpayers creates a gap in the national accounts that must be filled by either spending cuts or additional taxes on those who remain. The Henley Report flags France and Germany together, two of the most important economies in the developed world, simultaneously losing confidence among their most mobile residents. Our next stop is South Korea. South Korea's departure story is the most socially complex on this list because it is not primarily about tax. It is about a specific form of pressure that has been building inside Korean society for decades and that the country has not found a way to release. South Korea has one of the highest rates of educational attainment in the world. Its universities produce engineers, doctors, lawyers, and finance professionals at a scale that its domestic economy cannot fully absorb at the salary levels those graduates expect. The competition for the limited number of top corporate positions at the major chaebols, the government ministries, the prestigious law and medical practices, is so intense and begins so early in life that it has produced a generation of highly educated people who have spent their entire youth preparing for a race that, for most of them, ends in exhaustion rather than reward. The housing situation accelerates the pressure. Real estate prices in Seoul have risen to levels that make homeownership in the city essentially impossible for someone in their 20s or 30s earning a professional salary, regardless of how disciplined their saving has been. South Korea's fertility rate, already the lowest in the world, continues to decline, driven in part by young Koreans who have calculated that they cannot afford to raise children in the society they live in. The Henley Report identifies South Korea as one of the countries experiencing significant outflows of its high-net-worth residents and young professionals toward North America and Western Europe, where work-life balance is better, housing is more accessible, and the social pressure to perform at maximum intensity from childhood is lower. Then there's New Zealand. New Zealand is the country that consistently tops surveys of where people would most like to live if they could live anywhere. It is clean, safe, democratic, beautiful, and geographically isolated enough to feel genuinely removed from the turbulence of the world. People move to New Zealand and are supposed to stay forever. But they are not staying. New Zealand is experiencing one of its largest net outflows of residents in recent history, with its own citizens, particularly the young, leaving primarily for Australia and the United Kingdom. The reasons are economic, and they are simple. New Zealand's wages have not kept pace with its cost of living. Auckland's property market has produced house prices relative to local incomes that rank among the most unaffordable in the developed world. A skilled New Zealander, a nurse, an engineer, a software developer, can earn significantly more in Australia for the same work, in a country with lower property prices in most cities and the same cultural and linguistic familiarity that makes relocation frictionless. The geographic isolation that makes New Zealand feel like a sanctuary also makes it economically vulnerable. It is far from the major global markets, expensive to reach, and limited in the scale of commercial opportunity available domestically. Young New Zealanders with ambition and international options face a calculation that their parents did not face in the same form. The country that shaped them cannot offer them the career, the income, or the home that their qualifications should command. This video isn't just about rich people changing their address. They're not fleeing war or poverty, they're simply choosing better opportunities. In the end, countries that compete for talent and investment are likely to grow stronger, while those that fail to do so risk watching their wealth, innovation, and future leave with them. More people with the means to choose are looking elsewhere. The competition is no longer just for businesses, it's for people. And the nations that win that competition will help shape the future.